Okay, this is a very interesting question. In terms of technology, we know that one of the main drivers for this year is the increasing regulation, and obviously all of us we've heard about the introduction of CCPs. In this respect, we envisage that this would impact dramatically the market in the respect that now a lot of the FX trading would be cleared over these clearing houses, which would entail providing adequate tools in order to support this activity. We could see that happening in a couple of ways. In terms of equipping the clearing houses themselves, investment in terms of by the clearing members, as well as technology investment on behalf of the end users. So this is one interesting aspect for the year. Second trend that we believe that would increase during 2011 is the usage of ECNs, i.e. electronic connectivity networks. So we envisage more growth in this tool, I would say. We see more, now it will not be only the cash trading, if you like, spot trading. The next step is, we know, which is undergone, is trading of vanilla options, and eventually one could anticipate more exotic structures being traded via ECNs. And interestingly, the FX market in this respect is following trends that we've already seen within the equity derivatives market. So this is clearing, and this is electronic trading. I would say these are the main two trends that I foresee for this year. Sure. So actually, there are mixed views in the market on with regards to the impact of the increasing regulation. So some perceive it as a risk for the business, and having players become reluctant to trade due to increasing margining and the operational complexity and cost. The flip side of that we actually believe that this is an opportunity for the market, and actually if players would feel more secure, and that then this could actually increase transparency within the market, as well as boosting confidence. Right. So moving options options trading into ECNs basically could entail, first of all, from the market taker's perspective, this means increased transparency, price transparency. It means lower trading costs and better execution. From the market making side, this means that business that is now being more and more commoditized would be traded in a more efficient way, leveraging off economies of scale, and actually liberating the, shall I say, highly educated or highly proficient sales and trading force to focus on the high margin business. And of course, this also entails from both sides, reducing operational errors. And then it would mean that after execution, trades could be STP directly into the booking systems. Again, liberating resources to focus on more interesting stuff and with a higher return, if you like. Okay, the FX market trading electronically means, first of all, increased transparency for all users, means reduced trading costs, or in other words, the bid-ask spreads will be tightened. As a market taker, I will be able to trade on the best prices available. It also means that from a MiFID perspective, the ability to show trading on best price available. So actually quite beneficial. From the market making perspective, this means that flows that are now being more and more commoditized would be traded in a more efficient way, hence liberating the resources to focus on higher margin business, as well as reducing operational errors and costs for both market participants, i.e. market takers and market makers. So basically we are pretty bullish and happy with this new trend. So we've heard that one before. Taxes are not necessarily a bad thing. In this respect, CCPs would be actually are there in order to mitigate risk, right? And we think that, and we believe that CCPs would potentially increase transparency within the market. More transparency means more confidence. More confidence could entail larger volumes to the benefit of everyone, and as well as the investment community. Right. So I'd like to remind also the CCPs. We really need to think about how the CCPs would be implemented. It could be something very positive for the market, as we just mentioned. At the same time, one has to be careful because we do believe that CCPs would be implemented on a regional basis, i.e. different CCPs across different regions. It would make sense to have an Asian clearinghouse as well as a North American as well as a European one. Now, one has to pay attention that in terms of competition between different CCPs, if one clearinghouse was to offer a more aggressive policy of margining, this could also create systemic risks within the system, as all flows would be, or many flows would be redirected into this house. Hence, instead of mitigating the risk will be actually concentrated. So that's a point to think about. In the FX market, unlike the equities market, most of the activity of corporations is related to the commercial activity. Now, if corporates will have to post margins as a part of their hedging activity, this would mean that they would have less cash to invest in their commercial activity. In the current climate of fragile recovery, do we really want this cash to be posted as margins, or do we want this cash to be used to generate more jobs? I suggest the latter.